The air crackles with possibility, doesn't it? The promise of crypto, of digital gold, of a financial frontier. It's intoxicating, but the market, my friends, is a harsh mistress. And today, we're not here to chase rainbows. We're here to talk about survival. Because in the volatile world of crypto, one misstep can erase everything you've worked for. Think of Warren Buffett, the Oracle of Omaha. His first rule of investing: never lose money. Rule number 2, never forget rule number 1. Simple, isn't it? But in the dazzling chaos of the crypto market, this foundational principle is often lost in the noise. I'm not here to scare you, but to prepare you. Because the truth is, many investors are unknowingly making a critical error. An error that could wipe out their entire portfolio. This isn't about technical analysis or the latest coin. It's about something far more fundamental. Portfolio concentration. Have you ever heard the stories? The early adopters who bet everything on a single coin. The investors who poured their life savings into a project only to watch it vanish. These aren't just cautionary tales. They're a stark reminder of the dangers of putting all your eggs in one digital basket. So, what is this mistake? How does it work? And, most importantly, how do you avoid it? Over the next few minutes, we'll dissect the hidden mechanisms of this risk using data, not just headlines. We're going to build a strategy to protect your investments. Because in the world of crypto, knowledge isn't just power, it's survival. Let's dive deeper. What exactly is this concentration we're talking about? In essence, it's the opposite of diversification. It means holding a significant portion of your portfolio in a single asset or a small group of closely related assets. Think of it like this. Modern portfolio theory tells us that spreading your investments across different asset classes reduces risk. But in the crypto world, many investors ignore this fundamental principle. Consider the historical data. Look at the charts of past crypto crash. Notice how concentrated portfolios were decimated while more diversified ones fared relatively better. It's a brutal lesson etched in the market's history. Some might argue, but the potential returns are so high, and yes, the allure of massive gains is powerful. But remember, high risk rarely equals high reward. It often equals high potential for loss. We've seen countless projects promise the moon, only to crash back to earth. So, how do you protect yourself? The first step is to diversify. Start by allocating your crypto investments across different categories: established cryptocurrencies, emerging altcoins, and perhaps even crypto-related stocks. Assess your risk tolerance honestly. Use tools to monitor your portfolio's health. Finally, let's talk about the human element. We all have biases: overconfidence, recency bias, the tendency to believe the good times will last forever. Be aware of these tendencies. Question your assumptions. Data's your friend. Use it to make informed, rational decisions, not emotional ones. Because avoiding this concentration is the first step in protecting your portfolio. Now, let's talk about the mirage of safe crypto. Because in this market, nothing is truly risk-free. Certain categories of crypto investments are particularly prone to attracting concentrated portfolios, often leading to devastating losses. I'm talking about meme coins, altcoins, and the siren song of initial coin offerings, or ICOs. Meme coins, they ride the wave of internet hype, promising quick riches. But remember, the market is not a joke. Underlying these coins is often a lack of fundamental value. Altcoins, many offer innovative technologies, but also face significant regulatory uncertainty and intense competition. ICOs, these projects can seem promising at first glance, but they often lack a solid track record and are vulnerable to scams. The buy and hold strategy, while effective in some markets, can be treacherous in the crypto space. The market is too volatile, too dynamic. Active risk management is essential. So, how do you navigate this minefield? Start by thoroughly evaluating the risk profile of each asset. Do your due diligence. Research the project's team, technology, and market. Look for red flags. Is the project transparent? Is it backed by a strong community? Let's look at an example. Remember the rise and fall of insert hypothetical failed crypto project. Many investors were lured in by the hype, ignoring the warning signs, the lack of a clear roadmap, the anonymous team, the unrealistic promises. These are the things that should have raised alarms. The lesson: don't be blinded by the potential for gains. Always question, always analyze, because in crypto, what seems safe often hides the greatest risks. Let's broaden our perspective to diversification. In crypto isn't just about owning a handful of different coins. It's about building a truly resilient portfolio. True diversification extends beyond the crypto world. Consider other asset classes: stocks, bonds, real estate. These assets can offer a counterbalance to crypto's volatility. Understanding correlation is key. Correlation measures how different assets move in relation to each other. High correlation means assets tend to move in the same direction. Low correlation means they move independently. During market downturns, highly correlated assets tend to fall together. This is why it's crucial to diversify across different asset classes. Don't fall into the trap of thinking that simply owning a variety of crypto assets automatically guarantees safety. It doesn't. You still need need to assess the fundamentals of each asset, the underlying technology, the team, the market. So, how do you build a truly diversified crypto portfolio? Start by defining your risk tolerance and investment goals. Then, allocate your assets accordingly. Consider a mix of established cryptocurrencies, emerging altcoins, and perhaps some crypto-related stocks or ETFs. Rebalance your portfolio periodically. What about stable coins and other safe haven assets? They can play a role, but they also carry risks. Research the stable coins backing, understand the potential for depegging. Remember, diversification is not just about spreading your investments around. It's about building a portfolio that can withstand the inevitable storms of the market. Let's turn our attention inward, because the biggest threat to your crypto portfolio isn't always the market itself. Sometimes it's you, our own emotions, the psychological traps that can lead to disastrous decisions. Consider FOMO, the fear of missing out; herd mentality, the tendency to follow the crowd; loss aversion, the pain of losing that's often greater than the pleasure of gaining. These biases are powerful, and they can wreak havoc on your portfolio. We've all seen it happen: the frenzy around a new coin, the rush to get in before it's too late, the panic selling when the market turns south. These aren't just anecdotes, they're the consequences of unchecked emotions. Can you eliminate emotions from investing? Perhaps not entirely, but you can learn to manage them. Recognize your biases, develop a disciplined approach. How do you build this discipline? Start by defining your investment strategy. Stick to your plan. Don't let short-term market fluctuations dictate your decisions. Take a step back, evaluate the situation rationally. There's also mental accounting. We treat money differently depending on its source or how it's categorized. Be aware of this. Don't make impulsive decisions based on a perceived win or loss. Investing in crypto is a mental game as much as it is a financial one. By understanding your psychological weaknesses, you can protect your portfolio from self-sabotage. Let's bring it all together. We've covered the dangers of concentration, the hidden risks in popular investments, the importance of diversification, the psychological traps that can derail your progress. Now, it's time to build your crypto fortress. First, assess your risk tolerance. Be honest with yourself. Are you comfortable with volatility? Define your investment goals. What are you hoping to achieve? Then, develop a personalized strategy. Decide on your asset allocation. Determine your rebalancing schedule. There are tools to help you along the way: risk management checklists, portfolio trackers, market analysis websites. Use them. Stay informed. Consider the example of insert hypothetical successful crypto investor. This individual understood the importance of diversification, risk management, and emotional control. They built a portfolio that could withstand market fluctuations. The path to financial freedom in the crypto world isn't paved with shortcuts. It requires knowledge, discipline, and a willingness to learn. Take control of your financial future. Avoid the common mistakes. Embrace the principles of sound investing. Remember the words of Benjamin Graham: the investor's chief problem and even his worst enemy is likely to be himself. We've reached the end. Let's recap. We started with a warning, a stark reality, the one mistake that could wipe out your entire crypto portfolio: concentration, putting all your eggs in one digital basket. We've explored the risks, the psychological traps, and the strategies to protect yourself. Remember, diversification is not a suggestion, it's a necessity. Risk management isn't optional, it's essential. A disciplined approach is your shield against the emotional roller coaster of the market. But the crypto world is constantly changing. The market evolves, new technologies emerge. The only constant is the need for continuous learning. Embrace this. Stay curious, keep questioning, because the best investors are always students. As a starting point, I urge you to insert specific, actionable tip. For example, download the risk assessment template linked in the description below. Take that first step. Start building your fortress today. So, the question remains: are you building a crypto portfolio or a house of cards? The choice, my friends, is yours.